The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg headquarters in New York, I'm Katie Greifeld. Matt Miller, you're here once again.
I am here helping to kick you off to the closing bell here in the United States of America. Let's get a check on where markets stand. Good day today for a number of reasons that I'm sure Katie's going to expound upon. But bank earnings were strong. Another big AI deal pushes us up 0.5% on the S&P, even further on the tech-heavy NASDAQ. 24,776, so getting back closer to 25. The 10-year yield holding steady at 404. I thought, we could have seen today a drop below that level, that big round number, but we haven't seen it. We have seen a jump above this big round number, more than $4,200 for a troy ounce of gold. Katie Greifeld, so yet another record for the shiny metal.
Another record. Let's get into all of that and more, because Wall Street grappling with trade woes and dip buying as equities fluctuate. That follows one of the best 6-month stretches for stocks since the 1950s. The market has seen brief bouts of profit taking, though, amid a flare-up in trade tensions. Treasury Secretary Scott Bessent reportedly floating a longer tariff truce in return for China putting off its recently announced plan to tighten critical rare earth metals.
If China wants to be an unreliable partner to the world, then the world will have to decouple. The world does not want to decouple. We want to de-risk. But signals like this are signs of decoupling, which we don't believe China wants. And again, we do not want to decouple.
So some stern words there from the Treasury Secretary. But while equities seesaw, exchange-traded fund inflows have pushed past $1 trillion. That is the fastest haul that the industry has seen in its 30-year history. Now, with more ETFs than stock now, you have analysts projecting that this year could see almost $1.3 trillion in flows, and investors could continue to pull cash from mutual funds in favor of ETFs. But the other story boosting stocks today, Matt touched on it, that is the big banks continuing to rally on solid results from Morgan Stanley and Bank of America. And it's not just the banks. You have ASML Holding lifting the chip sector after positive comments on AI demand. Now, earnings season seemingly fueling bets that the strength of corporate America will keep this positive momentum going, Matt Miller.
I've got, speaking of positive momentum, a look at earnings, an American flag of earnings here, if you will. The white line is just the S&P index up until, the little slip that we had on Friday. Here in blue was the second quarter. And, of course, expectations came down big in April, but they came back up into the season, and we ended up beating by about 7 percentage points, maybe even 8, I guess. 12.77% was the growth, and we were only looking for about 5% in earnings. This is Q3. Now, we're expecting 7.2% earnings growth, which would be, if it comes out at that level, the weakest that we've seen in 2 years, Katie. But typically, of course, we go down into earnings season and then beat by about 5% and change over the last 10 years. Over the last 2 quarters, about 7 or 8%, as I said. So we're looking to heartily beat that, and that should keep this white line continuing to head up and to the right.
All right, let's keep this conversation going now with Nguyen. She is the CIO of equities over at Research Affiliates, joining us in studio. Great to see you, Nguyen.
Nice to see you again, too.
So let's pick off where Matt left off, and that is earnings. And what we've seen so far from the big banks, it seems to be strong. But when you think about the momentum and the strength that this market needs at these valuations, do you think that corporate America is up to the task?
So people talk about valuations, but let's just talk about what they really are. I mean, the S&P 500, which is dominated by these very large, richly valued companies known as the Mag 7, is really only trading at 25 times earnings, right? And so if you take those companies out, then the valuations are much less. You look at the S&P equal weighted, you look at anything that's not dominated by these 7 companies, valuations don't look cheap, but they're also not that bad. Even at 25 times earnings, I would say that given where interest rates are headed, which is down, it's really not horrible.
And it's good context, too, because people do talk about valuations. They talk about nosebleed levels. But looking at the index level, as you say, you could make a case that it's reasonably priced. When you look a little bit more specifically, though, when you think about what math it takes to get to that average, I have to imagine that there are certain sectors, certain groupings of stocks that look relatively inexpensive right now.
Sure. I mean, if you look outside of technology, a lot of things are inexpensive. Banks are not expensive, for example, and you see these earnings coming through. I mean, those stocks have got to be interesting opportunities. Other areas that we're seeing is certain consumer stocks and also real estate stocks, right? I mean, you talk about real estate got really crushed by COVID. They took a while to get out of that slump, and now you're seeing some of these companies do quite well.
I wonder about banks. They've done very well, right? Morgan Stanley killing it on investment banking, on trading. Bank of America killing it on investment banking. We saw yesterday JPMorgan, Goldman Sachs beat, but these banks are trading at 2.5 times book, and I'm used to looking at numbers closer to 1. Of course, banks had a rough time over the past 5 years or so. Where do you think they should be?
So I actually think that they're probably right around where they should be. I mean, you can't just look at these banks over the last 5 years or so, right? If you go back to, I mean, everybody wants to talk about, oh, it's AI, it's a tech bubble, it's all of that. The last time we had a tech bubble, which was in the late 90s, banks did really well. And part of the reason banks did very well was they took advantage of the risk on sentiment. People wanted to get invested, people wanted to trade, but also a lot of technology companies wanted to raise capital, either equity or debt, arrange deals. I think that as long as we continue to see excitement in business, whether it's AI or something else, these banks are in a position to capitalize.
You made a great point that we're in an we're in an interest rate cutting cycle right now. I think the terminal rate on the WIRP function is forecast at between 2.75% and 3%. Who does that help the most? I've noticed small caps rallying a lot more lately, but it's got to help the Mag 7 as well, right?
I think it helps everything, but I think if you're really looking for the big opportunities are in companies that are cheaply valued, right? So small cap companies, but also emerging markets.
Also emerging markets. There's certainly been a lot of focus outside the U.S. this year, but I do want to go to a point that you make in your notes, and that is that the macro risk right now is specifically trade. It's not inflation. I think that would take a lot of people by surprise, since we've been so focused, of course, on the interplay between what we're seeing in the unemployment market or the unemployment rate and, of course, what's going on in inflation, neither of which we're getting official updates on right now. But talk us through why you think that specifically trade trumps those two.
Really because people are worried about inflation because of the trade war. But I think that you can contrast what's happening now versus what happened in the first Trump administration. In the first Trump administration, he came in and his trade stance was very narrow and very specific. He said, we need to do something about China. This is what we're doing. He came out with rules. There was a deal. It was done. It was fast. People understood the new rules and they could move on. There was a one-time reset at that time and everybody moved on. People continue to take risk. People continue to invest. Now what we're seeing is that it's much broader net, right? Maybe it'll change over here. Maybe it won't. Maybe it'll change over there. Maybe it won't. Maybe it'll be high. Maybe it'll be low. Nobody really knows what happens next. In that level of uncertainty, you don't know how to plan. And so what that does is it hampers risk-taking sentiment. Companies pull back on investing, and ultimately that hampers growth. And so that, I think, is a much bigger risk for the economy and for markets than inflation itself.
You point out that Jones Lang LaSalle, Ralph Lauren, and MGM are companies that are reasonably valued and have demonstrated the ability to grow their top line and profitability. Why do you like these three?
So if you look at them, they're all trading with multiples in the teens compared to a 25 times on the S&P. You look at their top line growth, which is really what ultimately drives a company's success, because managing costs is something you can do internally, but getting that top line growth is hard. And over the last 3 to 5 years, each of these companies has demonstrated an ability to grow that top line while managing their risks. So those are companies that tend to continue to outperform on the top line. And I mean, these are companies that I think is unusual in that you find that combination of reasonable valuations and successful growth.
Also refreshing to hear about companies that are outside the AI ecosystem. Quay, great to get some time with you. That is Quay Nguyen. She is the CIO of equities over at Research Affiliates. Now, coming up on the close, with the government shutdown stalling key data reports, Deutsche Bank's Brett Ryan discusses how economists are crunching numbers without any numbers to crunch.
From missing numbers to mission-critical moves, JPMorgan Chase's Troy Rohrbaugh explains why he's zeroing in on companies strategic to keeping America's engine running.
And speaking of horsepower, Ferrari's CEO takes us for a spin on what's next after its latest EV rollout. All that and more coming up. This is The Close on Bloomberg.
The government shutdown stretching into its second week with September CPI delayed until Friday. The privately sourced inflation data we do have showing strain from tariffs. And that add to that, Treasury Secretary Scott Bessent citing estimates the shutdown is hitting the U.S. economy to the tune of $15 billion a day. And it's a complicated picture. Let's discuss with Brett Ryan. He joins us, senior U.S. economist at Deutsche Bank. So we're not getting any data except for some delayed CPI figures, and it's actually next Friday, not the day after tomorrow. What do you expect we're looking at right now? Because I would feel like 3% and change is not unreasonable, but I know that BLS uses some old school shelter figures that.
Sure. So, yeah, we expect continued sort of march down very slightly in owner's equivalent rent in the shelter data, kind of, but more consistent with recent prints, a 0.2 to 0.25 there. Really the question, as you said, is on good spending, and that's where we see the bump, and we have core at 32 basis points, headline at a little bit over 40 and change. And so, from the Fed's perspective, it's, you're still the same story of, well, you have house prices and rents that are moving, sorry, not house prices, but rents moving, steadily down in terms of year over year and mostly normalized. But then you have core goods prices continuing to march higher. The other side of that, services, really comes down to what airfares are doing and a few other components.
Healthcare, right?
Healthcare, another important one, which is the whole point of the shutdown right now.
How closely, by the way, do you think the CPI numbers that we get actually reflect what we're experiencing as consumers? And I know it's, a big country and it's different depending on where you are, but I was talking this morning with Jay Hatfield from Infrastructure Capital, and he thinks that because of the old shelter figures they use, only updated every 6 months, we're actually looking at inflated figures compared to what the real inflation numbers would be.
Yeah, I mean, it's certainly there's a big lag between what these high frequency rent indices, new tenant rents, repeat renters. One that's a good indicator is the Cleveland Fed's all tenant rent index. That tends to be a leading indicator. So there's certainly a lag, and that's well known. And so but it's also not telling us that we're seeing a sharp slowdown that's meaningfully below the year rate that you're at right now. It's simply back to pre-COVID levels, which were, in around the 2% range. So I wouldn't say that the numbers are not reflecting what we're all experiencing here. I mean, we live in Manhattan; it's a little bit different story. But in general, over time, you're going to catch the trend. And the trend is what's most important for the Fed's perspective and from the Fed's outlook.
I do want to talk about the other side of the Fed's mandate here, and that, of course, is what's going on in the labor market. We did hear from Fed Chair Jerome Powell yesterday talking about what we're seeing in the labor market, which we're also not getting updates on. But he made the point that further declines in job openings might show up in unemployment. And that's one of the big questions, right? I mean, how much weakening are we going to see in the labor market? Right.
So with what Powell's pointing to is the beverage curve. And typically when you get to a point on the beverage curve with job openings where they are now, further declines tend to result in sort of nonlinear dynamics and in terms of increases in the unemployment rate. It's always, I think, a little bit, you want to be careful with the JOLTS data, especially with a survey that has a 30% initial response rate. And so, it's pointing to one metric is not exactly the broader picture. I think Powell mentioned a number of other metrics of labor slack, because right now they're really not sure how much is demand accounting for the slowdown in hiring versus supply side dynamics with immigration.
I always think the beverage curve is going to be something a lot more fun than what it actually
Me too.
is. But I digress. I do wonder at what point, though, the fact that we aren't getting these economic data releases, when that starts to become a problem for the Fed. Because listening to Jerome Powell yesterday, it seems like, of course, they know what they're going to do this month, and they have enough data to make that decision. But if we start to drag into months on this shutdown,
Sure.
at what point does the Fed just have to hold up their hands?
Yeah, and it's not just the data itself; it's the quality of the data. So as we with the September CPI. It's already passed the survey period. They've collected a lot of information. But as we learned in 2013, when you get to the October report and the shutdown lasts and it affects that survey period, which is this week, you start to get diminished coverage, right? So your samples aren't as robust as they normally would be. So they collected 75% of the normal sample size in the 2013 shutdown scenario, and that ended just about this week. So we look to be blowing way past that by all accounts from reading the tea leaves. The next stop is kind of November 1st. And it's an important reason why, because this whole shutdown is about the ACA premiums. And both sides know that if they lapse, you're talking about doubling of out-of-pocket expenses for 20 million plus people.
Right.
And
Not rich people.
And no, not rich people. Not only that, that'll show up in inflation.
Yeah.
And it does, and not necessarily in PC, it's a little indirect, but in CPI, you will see those effects. That's not a good message ahead of the midterms. So both sides have an incentive here. It's just a matter of when do they knock heads and push comes to shove.
Absolutely.
And that's going to be November, hopefully, when those letters start to go out to the ACA folks for enrollment.
All right, so just one of the dates to keep an eye on here, November 1st. Brett, great to get some time with you. That is Brett Ryan. He is senior U.S. economist over at Deutsche Bank. Now coming up, Bank of America and Morgan Stanley getting an earnings booth after both banks beat estimates. We'll take a closer look at those reports next. This is The Close on Bloomberg. Well, it's time now for our top calls and look at some of the big movers on the back of analyst recommendations. And we start with NVIDIA. The NVIDIA of the chip sector gaining another bull with HSBC upgrading the semis giant to buy from hold and raising their price target to a street high of $320.
Isn't NVIDIA? It is the NVIDIA of the chip sector.
I'm not sure what that script was, but it was very fun and we had a laugh. In any case, the analyst is forecasting continuous earnings growth given the ongoing AI expansion. Shares currently up a little bit higher. Next in line, we have Uber. Guggenheim initiating coverage with a buy rating and a $140 price target. The firm also naming Uber as its top pick in the rideshare and delivery sector, noting that their AV adoption efforts will help them maintain their lead in the space. Shares down very slightly.
Autonomous vehicle.
Yeah, indeed. Finally, Nike. BTIG starting coverage with a buy rating and a price target of $100. Nike is one of 23 firms in the consumer retail industry that BTIG is adding to its coverage, so a busy day here. The analyst saying that Nike, though, is their top pick for 2026 and believes that the company is making solid progress on its recovery. Shares up 1.6%, and those are some of our top calls. Now, two other companies in the green today are Bank of America and Morgan Stanley in the wake of their latest earnings results. Let's get right to Jason Goldberg. He is senior analyst following the U.S. large cap bank industry over at Barclays. I want to start with Morgan Stanley, actually, because you point out, of course, that it tied JPMorgan for its strongest year-over-year increase in trading revenues. So clearly some good news there out of Morgan Stanley.
Yeah, absolutely. I mean, I think they kind of firing on all cylinders this quarter. You had very robust trading results, strong increase in investment banking fees with upside in equity and debt underwriting as well as M&A, and a strong pipeline looking out. And also both asset management and wealth management post strong results. So clearly the benefiting from kind of resurgence in markets activity, along with continued share buyback and controlled expenses.
All right, in terms of the beat from Bank America, we had a massive jump in investment banking, right? I think 43% higher revenue than the same quarter last year. What is Brian Moynihan doing right?
Yeah, listen, they were up over 40%. Morgan Stanley, Goldman Sachs were also, had pretty strong quarters. After, I would say, a couple of years of kind of subdued activity, the environment's gotten a lot better. You have a new administration that's kind of more pro-growth. less regulatory constraints, and you're seeing really broad-based M&A activity and a pickup in IPO activity, particularly late in the quarter. So you're seeing kind of all the big banks benefit from that, and you've seen like 6, 7 of the largest banks, report so far, all pretty strong results.
And I feel like one of the standouts here of this earnings season, of course, is Wells Fargo being freed from the chains of that asset cap. And they came out with that updated guidance for ROTCE, that target of 17 to 18%, certainly above the expectations that most had gone into the earnings with. How confident are you that they'll actually be able to reach that target?
Yeah, we certainly think we'll get there, and actually think over time they have the ability to do better than that. But they were single digits, not that long ago. They worked it up to 15% this quarter, and the asset cap just came off in early June. So the company has made kind of a lot of progress, and going forward, now they can actually grow its balance sheet in place and catch up some of the peers. We expect their earnings to follow, and at the same time, as the regulatory backdrop gets a little bit easier, the ability to kind of work down capital, buy back a bit more stock. So you should see kind of the numerator go up, the denominator go down in the ROTCE calculation, and certainly they have the ability to put up better numbers looking out.
We're all about the big money center banks here, but I have to ask about PNC because you have it as an overweight, and a lot of people on the street love this bank. It's getting a hit today because it's having to pay, I think, more for its deposits than investors would like to see. What's your take on PNC and the regional banks?
Yeah, listen, I think for PNC, maybe a little bit of overreaction. While their deposit costs did kind of look like they went up, it was basically more of a mix shift. You saw pretty strong commercial deposit growth this quarter, which they get, a good return on. So overall, I thought the quarter was, was fine. They kind of were in line to better than expected, pretty much on all the guide points that they laid out. And the future looks bright. I think just relative to some of the bigger banks, that print over the last couple of days that had pretty strong, trading and investment banking results are just not as big in those buckets. And you're seeing kind of a little bit of pullback after a good run. We do get, the rest of the regional banks in the coming days. And I think a lot of the themes we've seen so far should, bode well, right? Loan growth, deposit growth, modest margin expansion for several, good fee income trends, positive operating leverage. And, I think despite some concerns going into the quarter, so far credit quality has been relatively stable.
All right, Jason, great having you on the program. Look forward to talking to you again soon. Jason Goldberg, their senior analyst following the U.S. large cap banks at Barclays, as well as some of the regional banks that we talked about. Coming up, Troy Rohrbaugh, speaking of the big banks, JPMorgan Chase Commercial and Investment Bank co-CEO, joins the program for an exclusive interview on JPM's investment strategy and how it's working with the Trump administration. This is The Close on Bloomberg.
You should assume that whenever something happens, we need to scour all process, all procedures, all underwriting, all everything. And, we think we're okay in other stuff, but my antenna goes up when things like that happen. And I probably shouldn't say this, but when you see one cockroach, there's probably more. And so everyone should be forewarned on this one.
That was JPMorgan Chase CEO Jamie Dimon talking about bugs there to reference the bankruptcies of auto lender Tricolor Holdings and car parts supplier First Brands. It's just about 3:30 p.m. in New York. This is the countdown to the close. I'm Katie Greifeld. I'm Matt Miller. That is one of my favorite conversations of the day because Jamie Dimon said that, and then Danny Berger, who's at the CAIS conference with Romaine out in L.A., asked Mark Lipschultz about it from Blue Owl. And Dimon was essentially throwing a little bit of shade on BDCs, right? Business development companies, private credit. And Lipschultz was like, hey, there's no cockroaches in my kitchen, baby. It's spick and span. And then Howard Marks also said, we saw the problems at First Brands months in advance and actually made money on that trade. So made money on that trade, didn't tell anyone else. It was funny to see those comments from Lipschultz, basically saying that actually the issue was in the loans that the banks led. So it's not private credit. Everyone's friends until the losses starts. That's the lead in the Bloomberg
alleged
story.
Fraud can happen to anyone. For the outlook of another JPMorgan executive, let's go to Lisa Abramowitz. She is the co-host, of course, of Bloomberg Surveillance, joining us from Washington, D.C. for an exclusive interview with Troy Rohrbaugh. He is JPMorgan Chase Commercial and Investment Bank co-CEO. Lisa?
Thank you so much, and welcome to everyone on Bloomberg Television, on Bloomberg Radio. I am here with Troy Rohrbaugh. He is the co-head of the Commercial and Investment Bank and a member of the Operating Committee at JPMorgan. Thank you so much for being with us. I want to start with this recent announcement about a $10 billion equity investment that JPMorgan is going to be making in critical areas in the U.S. in terms of companies. What does this entail in terms of building out staff, building out capabilities beyond what you already have?
Well, first off, it's great to be here. Thank you very much. The strategy has two prongs, and we're really excited about it. One prong is capital investment on our part, arguably equity into different ventures of up to $10 billion. And the second piece is $1.5 trillion of financing. Now, to be fair, we were arguably going to probably do close to $1 trillion on our own naturally, but this really gives us a chance to double down on critical industries for American security and for our allies as well. In terms of staffing, the capital investment, we're going to hire a new team to do that. They're going to be professional investors. They're going to make decisions independently on their own. We'll have an advisory board. And again, we're really excited about it, but that's going to be a new group which we hire for. In terms of the financing piece of it, is we have a lot of infrastructure already in place, but we think we're going to need to hire some more people to help us expand the effort from roughly $1 trillion to $1.5 trillion.
How much is that new group directly in competition in some ways with some of the private asset managers that have been investing heavily in infrastructure, particularly in this space?
Sure, we just don't view it as competitive. And look, I know people love that narrative. They love talking about how banks and non-banks are fighting with each other. But we have a really, really long-term track record of engaging clients and managing the conflict when they are competing with us and when they're a customer. And the vast majority of the time, they're a customer. So, while there'll be specific deals, probably outside the space more often in things like private credit, where we really compete with each other, the vast majority of it will be an opportunity to partner. And I'm not worried about it at all.
So partnering with private asset managers, how much are you also expecting to partner quite a bit with the government? We're in Washington, D.C., and they're doing the same thing, evidently.
We're doing this on their own. This is a JPMorgan initiative. It's entirely on our own. But we're realistic. There's going to be opportunity to partner with other people, asset managers, as co-investors. And there's the probability that we end up in a partnership or in the same investment with the government, and that's okay too.
Yeah. Well, in the meantime, you just reported earnings, and they were pretty incredible. All of the banks really came out with pretty tremendous results. The profitability in the banking sector in particular, pretty blockbuster. I'm just wondering how big the pipeline is to continue this type of activity in M&A and deals and debt issuance.
Sure. I mean, I've honestly never seen a summer like we've had or a Q3 that we've had. It's just incredibly rare that you have every line of business achieving such incredible results that you mentioned we reported yesterday. I mean, security services, payments, investment banking, markets. Normally, if markets is busy, nothing else is, because it means something happened bad in the middle of August. And if banking is busy, markets tends to be slower. So it's a pretty incredible moment. Obviously, as you said, it's flowing through into earnings. It's hard to tell how much longer it's going to last. It won't last forever. But the banking pipeline is very robust, and we would expect that to continue through Q4 and hopefully into next year.
What's spurring that? Is it really more certainty on some sort of geopolitical standpoint? Is it because the expectation of Fed rate cuts is percolating into markets?
I think it's a little bit of everything. I mean, I would say corporate confidence is really high. The trend of the Fed is definitely helpful, but I don't think that's the primary driver. Tax policy is known. So I think some of the really big uncertainties early in the year are out of the way. Some still exist. And I think there's an opportunity for people to really lean in and make strategic transactions that they want to get done now. And there's been a little bit of a pipeline buildup that we're experiencing the benefit of today.
You were talking about the narrative that people in the media like to spur about private credit and private asset managers versus the big banks. And of course, that was kind of bolstered with some of Jamie Dimon's recent comments about cockroaches. You only see one, and maybe you see that there are probably others as well. And he was talking about some of the recent issues in credit markets. Yeah. How concerned are you about some sort of systemic risk that is beyond the banking system that is really focused on credit?
Sure. I mean, I'm a trader by background. I worry about everything. And Jamie, I think when he refers to cockroaches, I mean, he can speak for himself, but he's really trying to keep us and everyone else on their toes. And, you're starting to see things that feel late cycle. And I would feel quite strongly that we're in the latter innings of a credit cycle. The problem when being in the latter innings, you don't know if you're in the 6th inning or the 9th inning, and no one will ever know until afterwards. So, equity valuations are very high, credit spreads are very tight. You're starting to see things that Jamie was referring to. I mean, whether it's fraud or whatever it ends up being, but significant cracks in certain businesses and business models all make you nervous. So while it could last certainly for another 6 or 12 months, we're just being a lot more cautious in how we think about credit.
What does that mean? I know that there were bigger loan loss provisions that were set aside, but is it also in terms of tightening lending standards as well?
I mean, we've always been very disciplined at JPMorgan. We always evaluate every deal on a standalone basis. And we're just making sure that we're sticking to what is our core credit philosophy, being very disciplined on the quality of the credit, the terms, the pricing. And I think as long as we continue to do that, we can be comfortable. We would hopefully avoid any very large missteps.
What's the mood like here in Washington, D.C. at all of these meetings? I mean, do people have a great deal of optimism because of what we're seeing in markets?
I think it depends on who you ask. I think in many ways, people are just confused. There's so many cross currents happening in the market at the same time, from geopolitics, global macroeconomics, markets. They're much more volatile than they were before. I think 3 themes really stand out to me that I get asked in virtually every meeting is the state of the U.S. economy, what's going to happen, is the Fed going to keep cutting, all sort of bundled around how the U.S. is doing. The second is U.S.-China relations. Trade is back front and center, particularly tariffs, and I think it had been on the back burner, and now it's back. And then the last thing, because it's the IMF and there's a lot of emerging market clients and regulators here, is the value of the dollar, particularly against the yen, is a big focus.
So we can dig into each of those. The first one, what do you see as the bigger risk? The idea of some sort of reacceleration in inflation or some sort of more significant deceleration in growth?
I mean, I would say the biggest risk is both. Deceleration in growth with inflation staying sticky or potentially going higher. I mean, there's some inflationary currents in the system, fiscal stimulus, et cetera. So, you could get a continued slowdown in employment while inflation stays sticky. And I think that's the most significant risk in my mind.
Do you see signs of that?
I mean, the labor market is definitely slowing. Growth seems to be holding up, but if the labor market continues to slow, that's going to be a crack for the consumer, and you potentially see changes in consumer behavior. And I don't see anything that's going to significantly drive down inflation. If anything, it will stay where it is, or in my opinion, tick up slightly.
The other issue is the geopolitics of the moment, and you're a global bank. I'm just wondering, from a global footprint standpoint, how much your life has changed over the past 6 to 12 months in terms of where you're expanding, how you're doing business as a U.S. bank, the biggest U.S. bank with a very international footprint.
Look, international has always been extremely important to us, particularly in the CIB. And we see tons of opportunity around the globe. I mean, I would say in terms of standouts, it would be the Middle East and Asia, particularly Japan, Australia, Southeast Asia. But there's really opportunity for us to grow everywhere, and we're really focused on it. I think historically, as a big U.S. bank, we've really benefited from the size and scale of our footprint in the U.S. And we're obviously in the center of both inbound and outbound investment out of the U.S. But we're focusing really hard on trying to build those non-U.S. corridors, Middle East to Europe, Middle East to Asia, Asia to Latin America. If I think about our future, getting that right, and we're already good in those places, but really getting it right is super important for us.
Is it awkward to have a presence in China at the same time that you're investing in strategically important companies in the U.S.?
No, not in my opinion. I mean, we're a global bank, and there are plenty of our customers, certainly even U.S. customers of significance, they're doing business in China. Our job is to be there for them. So we're going to continue to do that. I mean, we're investing in the very long term everywhere, China included. Obviously, we're cautious. Obviously, we pay attention to geopolitics and the economics on the ground. But, while there could be a worst case scenario, more than likely there's a path where we continue to be a partner with China. It might be very different than the past, but I'm comfortable we're doing it thoughtfully, and we're going to continue doing what we're doing now.
When it comes to the de-dollarization, do you actually see clients moving away from the dollar? Or is this sort of something that people are hedging against and then going into dollar-denominated assets as quickly as they possibly can to get some sort of exposure to artificial intelligence?
Look, I think there's two themes when people say de-dollarization. One is, what are they doing in the moment today with their U.S. assets? And we've seen very little evidence of people selling U.S. assets. What we've seen is people hedging their U.S. assets. So I think before, people had much lower hedge ratios. So if someone had a 50% hedge ratio, they're kind of going to 65 or 70. That's what we're seeing. We're not seeing them sell the underlying assets. The other part that people talk about is, like, is the dollar safe as the world's reserve currency? And I think it is. I mean, obviously, you can never predict forever, but I don't see that changing anytime soon.
The AI story is something that your team has talked about and you're investing significantly in. And I was so excited to look at the headcount of JPMorgan after these earnings. And I was looking, okay, has it gone down dramatically as you invest in AI and all the AI and the chatbots take over humans? And actually expanded, it actually went up in terms of the headcount. How do you explain that in terms of the efficiencies? Is it working in terms of creating value?
So I definitely think it's working, but it's still early stages. And we're simultaneously investing in it and reaping some benefits. But I think the really big benefits will come in the future. And you have to keep in mind, we're really growing. We're covering more clients. We're moving to more geographies. We're going to more cities in the U.S. It all requires people. So, what we see in 2 years or 5 years could be very different. But for now, I don't think it's contradictory that we're investing in AI, getting the benefit, and our headcount went up a little bit.
Do you expect that to continue in terms of the investment, not necessarily reaping benefits over the next, say, year, 2 years, or do you think it's going to be a more imminent type of transition?
I think it really depends on the part you're deploying AI. I think we're already seeing the benefits in specific areas of some significance. Fraud detection, operational efficiency, those things are very impactful already. And there'll be spots where you'll see headcount change, I think, in the near future. And you're going to see other spots where you don't see headcount change at all because we use AI just to do a lot more. But I think this will play out over the next 2 to 5 years, not necessarily the next 3 to 6 months.
Troy, it is wonderful to speak with you. Thank you so much for taking the time today.
Oh, it's been great. Thank you very much for having me.
And that was Troy Rohrbaugh of JPMorgan, and I will send it back to you.
All right, our thanks, of course, to Bloomberg Surveillance co-host Lisa Abramowitz, as well as Troy Rohrbaugh. He is the JPMorgan Chase Commercial and Investment Bank co-CEO. Some really big questions there at the end in terms of when are we going to see the payoff of some of the huge investments that JPMorgan has been putting into AI, especially as Lisa points out, their headcount has, of course, gone up since they actually started that.
Yeah, and look, they also have seen their share price go up. They actually bought back $8 billion of shares in the last quarter compared to $6 billion in the same quarter a year ago. They said, maybe this price is a little bit expensive, but we're going to keep doing this because we're churning out so much cash. They have a book value of 2.5, so they have a pretty strong valuation. I thought it was interesting, his comments on, Jamie Dimon's cockroach comments. He did say that they're going to be a little bit more cautious on credit right now. And I think everybody's watching, not just JPMorgan, but the credit space in general after these big profile bankruptcies.
Well, you know what Dimon said, when you see one cockroach, there's probably more. So we'll all be bug hunting.
Spoken like a true New Yorker.
Right. All right, coming up, we're about 15 minutes away from the closing bell. We'll take you there with Kara Murphy. She is Chief Investment Officer over at Kestra Investment Management. This is The Close on Bloomberg.
If you're really looking for the big opportunities are in companies that are cheaply valued, right? So small cap companies, but also emerging markets.
And that was Nguyen. She is CIO of equities over at Research Affiliates, helping us to kick off the show. Interesting to get those comments about small caps there. I was glad you brought them up because, boy, they just can't catch that sustainable bid that many have been calling and waiting for.
By the way, it's strange because every morning at the open, I'll look at, or before, I'll look at futures.
Yeah.
And the Russell futures are outperforming every morning. What happens during the day, I don't know, because I leave here, right, at 11 o'clock on the dot. But
the American investors come in and they say, come on, it's not happening.
We do see the big cap stocks making all the headlines and making all the deals. Small caps aren't paying $40 billion for a data center that's going to start building its infrastructure, 5 years from now. NASDAQ outperforming, obviously, the S&P right now, as you would expect, because of that data center deal. And the banks, they did well, but a lot of analysts are saying they have already had a pretty serious run up. The 10-year yield, I think, interesting, 4.03%. This morning I was talking to Jay Hatfield. I will never forget being on set with you when he told us he expects the 10-year at 350 sometime in 2025, and we were like, are you insane? But it's headed that direction.
Yeah, I wrote about that in my diary. We're not quite there yet, but we do have a couple of months left. And the way that things are going, maybe we'll get there. It does seem like 4% is some sort of support level here. But for more market analysis, let's welcome in Kara Murphy. She is Chief Investment Officer over at Kestra Investment Management. Kara, great to have you with us as we count down to the close. Let's talk a little bit about where we sit when it comes to some of the trade negotiations, specifically the relationship between the U.S. and China, because something else we were talking about with Nguyen was the fact that, in her view, it's the trade that's the macro risk here, more so than inflation. And I wonder if you agree with that.
Well, I think what we've seen throughout this year is the market sort of torn between these two poles. There's overall policy uncertainty, of which tariff negotiations are a really big part, and then the sort of fundamentals of the market and the economy. And I think Friday was a great reminder that that policy uncertainty can sort of still rear its ugly head. And this is not gone. Even though the market has sort of pivoted away in many ways from these tariff negotiations, they can still be really meaningful. That said, the worst case scenario of these tariff negotiations, which is an all-out trade war, essentially an embargo against China, we think is largely off the table, right? That's what we had in late April when tariffs were put on pause. And so we'll end up somewhere in between nothing and really punitive tariff rates.
So also when it comes to what we're seeing between the U.S. and China, it seems like so much is focused not necessarily on those tariff rates, but on the non-tariff issues. Yesterday, of course, we all learned a lot about cooking oil and how much the U.S. actually buys from China. We've all been studying up on rare earths and soybeans. And I wonder, as an investor, how you think about all those different cross currents and what issue might actually come to the forefront next.
Well, it's very hard to predict what exactly that next sort of micro issue is going to be. But I think these all highlight how incredibly complex and global our economy has become, right? With the initial tariff announcements, all of a sudden companies were having to figure out, well, where do I actually buy my goods from? And now with China, we're trying to figure out, like, oh, what do we actually import? And what maybe doesn't show up as a really large import, but it's very, very important, right? The rare earths is really important. And are we more concerned about actually buying those materials or processing those materials? So we have very, very intertwined economies, not just with China, but with other economies throughout the world. And I think what we're seeing more broadly is this shift from a very unipolar world where the U.S. is at the forefront, leader in many, many different ways, towards a much more multipolar world. And what that means is that much more uncertainty in a lot of different areas, not just with tariffs.
You know, tariffs have been driving the gyrations in markets over the past few days, or the trade war tweets. And the AI bubble has been a huge discussion, and the concentration risk is real. I'm sure you'd agree. But no one seems to talk about the government shutdown in the context of the markets. Does it matter at all on day 15?
It does, because there are people who are being impacted by it. On the other hand, we've seen this playbook before, right? We've had government shutdowns since the 1970s. They've been of varying lengths, and there have been varying levels of success in terms of both sides being able to get something out of it. So I think what's happened is that the U.S. public has become a little bit more used to this dance. I don't think anyone's really convinced that we're necessarily going to get to a better place on the other side of it. But what does happen is every time we go through something something like this, where essentially we have parties that are not able to compromise, it does dent the credibility of the U.S. government in general. And right, we had all three ratings agencies who downgraded U.S. Treasury debt, but that's all in the past. And what we've seen is that U.S. Treasury debt doesn't become that much more expensive, but each one is like another little paper cut along the way.
I wonder what you think about the jobs picture that the Fed focuses on, because, you know, reducing federal jobs significantly will probably change the numbers we would have gotten were the government open. And you've got the threat of AI hanging over these jobs as well. Youth unemployment is like more than 10% right now. Are you worried about that?
So I think it's definitely going to represent some change that we all have to manage through. But let's remember that for a couple of years, we've been looking like with a microscope for weakness in the labor market, and it just hasn't come. So are we starting to see a little bit more looseness in the labor market? Yes, for sure. Is it still at a level that is relatively tight compared to historical levels? Yes. Now, to the question specifically about AI, I get this question a lot, particularly from parents who are like, what should my kid be studying, right? There's a lot of concern about what the job market looks out 5-10 years from now, not just tomorrow. And what we're starting to see is just little bits in the numbers where, for instance, you mentioned youth unemployment being higher. If you look at consumer scientists, young consumer scientists who are graduating from school have much lower levels of employment than what we saw previously. Now, more tenured people, those jobs are still growing, even in computer science. So I think what we're going to see is shifting of jobs from certain areas that are very impacted by AI to other areas that are less likely to be impacted by AI. And that takes time.
Right. Kara, that's a good place to leave it. Great to get some time with you. That is Kara Murphy. She is Chief Investment Officer over at Kestra Investment Management. Meanwhile, we're just a couple minutes away from the close, Matt Miller. And it's interesting. I mean, you think about now we're truly getting into the meat of earnings season and the importance that might take on, given that we're not getting any official updates from the government as to where we're actually going in this economy.
Yeah, no, earnings season is key. Actually, I just pulled up the EA function for the first time this season. We're looking at, so far, 39 of the S&P 500 companies have reported. And we're looking to get the official expectation from analysts, who always lowball it, is 7.2%. So according to DataTrek, over the last 10 years, we beat by an average of 5.1%. Maybe we'll be in the 12s.
Well, it's all about the guidance as well. But we are moving closer to this closing bell. Full market coverage right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
All right, we are about 2 minutes away from the end of the trading day. Katie Greifeld and Matt Miller in for Romaine Bosick. And here to help take us through the closing bell, we're joined by a global simulcast, Carol Massar and David Gura in for Tim Stenovic, bringing together all of our different audiences, glasses off for this moment. And Carol, it looks like we're going to finish just slightly in the green here.
Just slightly in the green, but we've been bouncing around a little bit, certainly in today's session. Again, I go to the semis, which we've often seen outperformance throughout 2025. As a whole, they're up about just shy of 3%. I'm going to get into some of the reasons why when I talk about some of my individual gainers.
I wonder what she's going to say.
What's
she going to say?
Well, I won't reveal. Carol talking about how the market's been bouncing around, looking at sort of how things are settling out at the end of the day here. Roughly half in the green, half in the red, but I think we're seeing this market that still is being driven by this roiling trade war that maybe has gone ignored or been less looked at, let's say, over these last few weeks. But that dynamic between the U.S. and China, I think, is something we're still following closely.
I think it's actually pretty surprising that it took us pretty much until Friday to realize that, wait, China said it's going to cut us off from pretty much all rare earth minerals. And, you know, we don't really have that many of those and desperately need them to make pretty much everything. So now we're paying a lot closer attention. Still, we're getting some really good news. Great earnings from the banks. We're getting continued multi-billion-dollar deals from super interconnected parties in AI. And that continues to drive up the Mag 7 or the Great 8, as Katie likes to call them.
That's true. And really, I mean, if you think about the index math here, that's all you need. But still, a more broad rally might quell some of these investor fears. But in any case, on the day, you can see the S&P 500 will finish in the green. We are bumping up against 6,700 on the S&P 500, not quite there. The NASDAQ also mightily in the green today, up about 0.7%. The Dow Jones didn't do anything. Let's just move right past that because the small caps had a pretty good day as well, Carol Master. So the little guys also getting in on the big rally.
So formal. Yeah. Catherine Greifeld.
Thank you.
All right, S&P 500. Let's go back there to the big caps. Almost an even split. 251 to the upside, 252, Katie, to the downside.
All right, we do have some news. This from not a big bank. Some earnings coming from United Airlines. Third quarter adjusted EPS beating estimates here, coming in at $2.78. You take a look at the estimate for $2.66. That is a beat here. Then you take a look at some of the other numbers as well. Third quarter CapEx coming in at $1.46 billion, and operating revenue for the third quarter also coming in pretty much on expectations. Still waiting to see some of the guidance here, but at least when it comes to the look behind, Carol, it looks like we got good news coming out of United.
Yeah, stock bouncing around here in the aftermarket. Right now, down 1.5%. It was just up 1%. It's a stock that, if I look year to date, is up 7%. But, go to something like revenue, passenger miles. Actually, let's go to the outlook because, Katie, you mentioned it, highlighted it. The company sees fourth quarter adjusted EPS of $3 a share to $3.50 a share. That, folks, is above what the street was looking for. They were looking for $2.82. So right now you're seeing investors saying, okay, folks, United, I like your outlook, and setting the stock up about 2.8%.
Yeah, absolutely. It does look like we're getting a kind of Delta Airlines set of earnings from United, and this may have to do with the fact that we are in somewhat of a K-shaped economy, right? Those who are doing well still want to travel, still want to buy tickets, and still need to fly premium economy because we want to be Group 1, right? So beating on the revenue in terms of or meeting on the revenue, I should say, in terms of $15.2 billion in the third quarter. On adjusted EPS beating, and then on the outlook beating as well, Carol, as you say, looking for $3 to $3.50, and we were only looking for $2.82.
Matt, I'm glad you bring up that K-shaped economy because we got that beige book from the Federal Reserve earlier today, and that was really manifest in the comments that we got from those regional Fed banks. The fact that we're seeing that division that you're talking about among consumers. Yes, the anxiety and agita just about the uncertainty that lies ahead, but then you still see people who are spending on services, and that seems, and you look at these data here, seems to be a good thing for this airline in particular.
Also, just, before I get into individual gainers, when you talk about spending, I mean, United talking about still on track, I think, to spend $1 billion this year in terms of improving the experience, product, and service, and then it expects to invest over $1 billion more in 2026. So
that is good news.
Yeah, right? They're spending. They feel upbeat. They're willing to do that. That is good news. And right now that stock is up 3% here in the aftermarket. All right, we'll continue to track for anything else after the market close here. Let's go to some of the individual gainers in the regular session. I got to highlight, Matt, you knew I was going to do this, AMD, because chips once again outperforming. Thank you, Advanced Micro Devices. That stock up about 9% here. HSBC affirming a buy rating on AMD, boosted its price target to 185 from 180. From 185 to 310. Yeah, talk about a boost. It's a street high. We know that they had that recent deal with OpenAI, so they're just, going gangbusters. Got to talk about the big banks continuing to report earnings. B of A up about 4.5% in today's session. And then you had Morgan Stanley up about 4.7%. B of A beating third quarter earnings. Investment banking activity increased, a long awaited comeback in M&A. We've been talking about this a lot. And then Morgan Stanley, their stock traders topping rivals on the surge in trading activity, and the CEO also saying he might slightly up the pace of buybacks. And one more, Papa John's.
Pizza.
Had to do it.
Yeah.
Up more than 9% here. Highest intraday since June. Reuters reporting that Apollo Global submitted a bid within the last week to take the pizza chain operator private at $64 a share, stock closing at $53.
Is it good? I'm not expecting it to be like a great local place, but I mean, compared to Domino's and Pizza the Hut, does anybody have experience with Papa John's?
Papa John's? It's been a while since I've ordered one, but it would be my preference.
It's no Sally's in New Haven. It's no Raza in Jersey City.
Wow.
I'm just going to put that out there.
Go far afield for those.
Full disclosure, I shop there or go there.
All the way to Sally's.
Yeah.
You should go to Rubino's in Bexley, Ohio. It's the best pizza in the entire country.
Yeah, says the dude from Ohio.
Let me do some decliners. I'm very curious if those gainers were in line with what Matt was expecting. expecting, but my decliners, the first one, get in the zone, AutoZone.
Whoa.
Investors squarely did not do that today, as we saw sizable losses there in that stock. And I think it has to do with a couple of things. The first having to do, of course, with the implosion of that First Brands group, and this company obviously has better credit than that company did before the bankruptcy. But I think it's a tariff story as well. This kind of roiling concern about whether an auto parts retailer is going to be able to get what it needs to get and not have to raise prices as much as I think many consumers fear it might. See that stock sagging today. The two other ones I wanted to flag kind of go together. They complement one another. It's Northrop Grumman and Lockheed Martin, these two big defense contractors. Such an interesting moment here for these defense contractors in light of the cessation of fighting that we saw in the Middle East. And I think also you have Ukraine coming to Washington. The president of Ukraine going to meet with President Trump tomorrow to talk about their desire to get more American weaponry. We'll see what kind of manifests itself from that going forward.
All right, we're looking at some earnings crossing now from J.B. Hunt. The trucker says third quarter EPS was much better than expected by 30 cents, $1.76. We were only looking for $1.46. Revenue looks like they had $3.05 billion in total revenue in the quarter. That's better than the $3.02 billion we were looking for. And they break it down to intermodal revenue, $1.52 billion, dedicated revenue, $864 million. So J.B. Hunt handily beating earnings expectations, certainly on the bottom line.
Yeah, you can see shares flying right now, up about 8%. This is a company that needed some good news. Shares down about 18% on a total return basis through today's close. But let's take a look at what is going on in the bond market. And it's a relative snooze, I would say. I mean, when it comes to the 10-year yield, we couldn't quite get to 4%. Not too much action in yields. I don't know if we'll show them, but I hope they do. But overall, there we go. You can see that the long end, maybe you could frame that as a gain, but overall, just some slight losses here on the Treasury market.
All right. Did I mention the Olympics to you?
Yes.
To Carol. I know I went into the radio studio earlier and talked about this a little bit with Carol.
Oh, good.
And David Gura, because I love the idea of...
Were you on air? Or
no, it was during a commercial.
We could have been.
During a commercial break. But I love the idea of these, these big cities bid on the Olympics, and all the naysayers are like, they always lose money, which for the most part is true. But LA is always held up as, the model of profitability for the Olympics, because they had an Olympics back, I think in the 80s, was it 1984?
That's right.
And they actually did well because they didn't plow a ton of money into new infrastructure, new stadiums, new facilities. They reused, and Carol, you're going to love this because the circular economy, they reused all of the stuff they had. For example, a stadium that was there since 1930.
Which is great.
And they ended up not losing a ton of money.
Yeah.
But that was then. This is now. They're prepping a $1 billion bond for their convention center ahead of the 2028 Olympics. I have to say, I'm psyched. Also, maybe this will be good for the muni market as well. But look at that.
A whole billion. Wow.
That's a lot. That's a lot.
Aggressive.
As you can see, the sign says a new era for Los Angeles.
I always think it's sad you go to a city that, where they hosted the Olympics and it's just like empty buildings.
Is that Montreal? Is that what you're talking about?
Well, or I was thinking up even like Lake Placid.
No?
It's a little quiet, although there's some stuff.
You go to Lake Placid?
Yeah.
For the pizza.
Did you ever go to the Mirror Lake Inn? No, listen, if you have not
I've been to the Mirror Lake. I've been there.
It's beautiful.
Yeah, sure.
Yeah, so but it's kind of quiet.
Yeah.
Down the luge.
Skate around the lake.
Yeah.
All right.
But listen, if you have not been, if you've not been to Sally's in New Haven, you should go. All right, I got to wrap because Finley's going to yell at me.
Rubino's.
No.
Rubino's in Bexley. It's right down the street from Grader's Ice Cream.
That's
Delicious.
a wrap.
Oh, that is
gotta
good.
go. Gotta go. Pizza over, guys. All right, that's a wrap across platform. Radio, TV, YouTube, Bloomberg Originals. We will see you again, same time, same place tomorrow.
And coming up on the close, those United results have landed, and we're taking a deeper dive on what's taking off for the airline and what's grounding results next. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Matt Miller. Let's take a look at where the markets closed out the day. We did have gains, not back to 6,700. We were up there and beyond for a lot of the session, but closed up only 0.4%. I think the closing high is 6,753, somewhere around there. So we're not too far off it. NASDAQ 100 gaining more because of the AI data center deal that we saw, the biggest in world history. Have we said that yet on this program?
Not enough.
the biggest data center deal ever with a whole group of people, BlackRock's GIP and a bunch of partners, including the Kuwaitis and Mubadala, coming together and paying basically $40 billion, including debt, for a data center company. The 10-year yield at 4%, almost flat there, 403, 404. And then gold. We haven't mentioned this either. I don't talk about gold enough.
Right.
$4,200, $10 a troy ounce. That is an all-time record.
Yeah, it is stunning what's going on with gold, also with silver, just with commodities in general. But let's take a look at some after-hours movers, because we did get some earnings results about 10 minutes ago from J.B. Hunt and from United Airlines. J.B. Hunt, good news there when it comes to third quarter EPS, beating expectations in a big way, also beating slightly on third quarter revenue as well. You can see shares flying after hours. But speaking of flying, let's talk about United Airlines, up marginally, 1.5%. That's certainly good news. They was a beat when it comes to the look back quarter. When it comes to the fourth quarter, the view there, adjusted EPS seen between $3 to $3.50. The estimate had been for $2.82. So certainly a big raise. What caught my attention was this spending plan that they're going to invest in added $1 billion in the customer experience in 2026, Matt Miller.
Yeah, absolutely. I mean, United Airlines doing as well, it seems to me, as Delta, which is to say they're getting a lot of growth and even more in the premium cabin than they are in the economy cabin, although the economy cabin is doing well, too. Let's bring in Bloomberg Siddharth Phillip. He's our chief correspondent of aviation and transport, joining us now at the desk here at 731 Lex. Am I right that this is on par with what we saw from Delta?
It is. I mean, this is similar to what we saw with Delta, and that's sort of showing the sort of results where United and Delta have both sort of focused on the premium end of the travel market, and that's really paying off for them, whereas some of the carriers at the bottom end of the market are still struggling. I mean, we're still seeing Spirit Airlines in its second bankruptcy. We're seeing the other low-cost carriers having to discount fares in order to get people on planes, and so the United bet is paying off.
And so I'm a journalist, but I'm also someone who flies on airplanes and frequently complains about it. So give us a little more detail what it means that United is going to invest that added $1 billion in the customer experience just next year. And give us some context. Is that a lot of money for United?
It is a lot of money for United, but it is a sort of thing that they've been spending on for a while now. They've been upgrading the passenger in-flight experience, so they've been sort of spending on lounges. They've also been spending on cabins and like essentially upgrading seats, adding more business class onto planes, making better business class seats, as well as improving. I mean, we had the United CEO a couple of weeks ago talking about how they're investing in food and beverage service and sort of investing a lot of money in in-flight catering and making that a better experience. So there is a lot of money that's going in, especially as you get those higher-end travelers who you want to keep them sort of coming back to you for more and continue to fly with you.
Lowest Q3 cancellation rate on record, and 6 out of 7 hubs first or second in on-time departures.
Not bad at all. Yeah, and it's interesting, of course, to hear the plans. It seems like really to invest more in the front of the plane, which gets more to your K-shaped economy comment. Sid, great reporting as always. United shares moderately higher right now. That is Bloomberg's Sid Phillip. He is our chief correspondent of aviation and transport. And of course, tune in tomorrow morning because Bloomberg Surveillance's Lisa Abramowitz will interview United's Scott Kirby tomorrow morning right here on Bloomberg TV. But coming up on the close, this is exciting. Ferrari CEO Benedetto Vigna is pulling up to Bloomberg headquarters. We'll discuss what's next for the luxury automaker as it joins the EV race.
It's exciting for me as well.
Everyone's excited. This is the close on Bloomberg. Ferrari unveiling a slate of new strategies and financial targets in its Capital Markets Day last week. Now, the more cautious than expected outlook, it sparked the stock's biggest intraday drop in 9 years, which overshadowed the launch of the luxury automaker's first ever electric vehicle. I'm pleased to say that we're joined live in studio now by Ferrari CEO Benedetto Vigna. Great to see you in person.
Likewise. Good afternoon.
So let's talk a little bit more about what exactly you said last week. It was the guidance for revenue growth and profit. If you map it out to 2030, I believe that only targets about 5% annual growth. So is that Ferrari being cautious prudently here, or do you actually see something troubling ahead when it comes to the luxury market?
But I think that the plan we shared last week is equally ambitious as the last one. I think that 3 years ago, we committed to deliver, and we delivered on our promises. We are committing, and we will deliver on our promises. So the confidence is over there. We want to address this market, this strategic view with the same greater determination as we did before.
So not setting the bar low to then surpass it?
I don't think. I mean, one gentleman in the capital market, they asked me if the plan was equally ambitious or not. And I believe this plan is ambitious, equally ambitious.
Michael Dean from Bloomberg Intelligence was there. He said he had a fantastic time, so well done.
Thank you.
But he did say he expected more in terms of free cash flow. You have 8 billion euros penciled in over 5 years. He's looking for 9. Shareholder returns, you have roughly 7 billion euros split between dividends and buybacks. He said he was disappointed by that as well. Why do you think investors or analysts, the street, is expecting more from you?
Maybe they are expecting, they believe that we don't care too much about scarcity. I think for us, scarcity is important. It's embedded in our business model. We want to make sure that the scarcity is always kept over there. I like to say that this is not a 100-meter sprint. This is a marathon, and we have to make sure that we do not alienate our client. Because if the client is happy, the investor is happy. The other way around may not work.
I think he's expecting more in terms of margins. I talk to him all the time, and he says, like, the margins on something like the Icona or the F80 are just jaw-dropping. He's looking for more like 43, 44, 45%. And you did forecast more than 40%.
We said two things, more than 40
yes.
EBITDA and more than 30 EBIT, right?
Yeah.
And I think we did also visibility for 6 years. I don't know many companies are giving visibility for so long nowadays.
Are you going to be selling more of these Iconas? These are the special, incredibly high price tag vehicles. I heard, for example, that you can order one with a gated shifter, which got me very excited. Next time I come up with $4 million, I'll put it in my order. But are you going to sell more of those in the mix along with the F80?
But I think that we have always to make sure that this Icona and this supercar are limited. There was a clear message from a clear chart from our CFO that was telling that the number of Icona supercars will not go more than 5%. And we want to stick to it. I think that to have our client happy, he has to feel that he owns something that not too many people can have it. And I think this is the business model of Ferrari. The scarcity must be managed well, and we have to take care of the client. This is important.
I do want to go back a little bit to last week and the Capital Markets Day, because it was a two-parter, right? You unveiled your financial targets, but you also were showcasing the Electrica, your first, of course, EV. And it's the opinion of Bloomberg Intelligence that really it was the EV technology that was overshadowed by the financial targets, that those ultimately ended up being the focus. And in hindsight, would you maybe have separated those two announcements?
I know this feeling of Bloomberg, but I have to say that I had a lot of other comments positive in this direction. They said it's good that you show to the community that what you said 3 years before, it was happening. Because 3 years before we said, we want to show you that we are on target and we are going to unveil the Electrica, Ferrari Electrica, and we did. So I think that I fully respect this point of view and this consideration, but I think it was important for two reasons. Number one, to show that we are on track and we deliver on our promises. Number two, that we had to show to all the people over there for the Capital Market Day to show the beauty of our new car.
And to be fair to the Bloomberg newsroom, I mean, the shares did drop by the most since 2016. So I don't know, maybe some of the Wall Street analysts shared that view as well. But I do want to talk a little bit more directly about electric Ferraris, because you lowered your targets to 20% of the lineup by 2030. Previously, it had been 40%. Would love to hear a little bit more about that decision to lower the target.
I figure that would drive the shares higher. You know, you're making more internal combustion engines than we expected. That's what we want from a Ferrari,
yeah,
right?
Matt, but look, I think it's important. Last time as this time, we said something important. This is not a split of our sales. This is a split of our offer. Because at the end of the story, it's the client that is going to select if he wants to drive ICE, hybrid, or Electrica. So it's up to him or to her to select. The reason why we dropped, or we reduced, we trimmed down the split of the 20% of the offer is because we have seen what is happening around us. So we pushed the number of model overall has been increased overall. And number two, in this mix, we increased the thermal, the ICE.
When are we going to see the body in white, and when are we going to hear it? Because apparently it's going to be amplified motor sounds.
Within H1 next year. We keep delivering on our promises. Phase 1, done. Phase 2 is going to be, let's say, in Q1, phase 2 in Q2, within Q2.
Can I talk about something that you probably are sick of hearing it from me, but analog versus digital, right? Yeah. You're putting buttons back on the steering wheel in the Amalfi, which I'm very...
Not only in Amalfi, excited in all the car of this year.
So that's fantastic. I imagine customers ask for that, right? You've still got, fields of screens in there. And I've driven a number of very expensive cars where they have screens replacing these elegant and beautiful analog gauges. Why don't we go back to clocks that are enamel with needles? Wouldn't that be more exciting for a Ferrari buyer?
Look, we said clearly that we are a big fan of phygital. It means that you use digital where it's needed and physical where it's needed. I can tell you that all the time this year we presented the 5 cars, the 2 Speciale, 6-cylinder, the 2 Testarossa, Spider and Coupe, and the Ferrari Amalfi, when we told our client and the entire world that we are going back to the button where you feel it, okay, without touching, without looking, because when you drive, you need to look at the road. Well, that was a big, big applause we had. So we will use digital where it's needed and physical where it's needed.
Can I just ask about the shifters? Because I spend so much time on Bring a Trailer. I'm looking at 360s, I'm looking at 430s, sometimes 575s and 612s. And I noticed that the premium for a manual is massive, 50, 60, 70%, sometimes even double for the manual car versus the auto box. So doesn't that mean customers want to buy that new too?
Look, you have to listen to client for something. For something else, you cannot listen. For something else, maybe some good hint for the future.
So maybe in the future you can just make a suggestion box and Matt can put his comments directly in there.
He has to come to see us.
There you go. Before we let you go, I do want to talk a little bit about China, because you take a look at some of your peers in Porsche, BMW, Mercedes on a slightly different price point there, but they're rapidly losing market share when it comes to China. And I wonder, when you look at that, are you confident that you're going to be able to buck the trend there?
But since the beginning, at least since I joined the company, we said that for us, China is, mainland China, Taiwan, and Hong Kong will be below 10%. That's what we said recently. I think that last year, Ferrari did not have an offer that was fitting well the Chinese market, because we were having only 12 cylinders and we had a Roma Spider with soft hat. It's not so welcome. Now we are going to change. We are enrich, let me see, the offer for China. Electrica could be also a good, interesting car for them, also because you will not have all the taxes that you have on ICE.
Well, and it could be a product that they embrace maybe more than other parts of the world. Great having you here. Thank you so much for joining us.
Thank you.
Benedetto Vigna, the CEO of Ferrari. Up next, we're going to talk about the IMF lifting global growth forecasts. This is Bloomberg.
We do have a huge amount of uncertainty in the world, right? I mean, there are major shifts going on. Measures of policy uncertainty are elevated, but of course markets are shrugging that off to some degree. It's somewhere in between, so like the broader big picture questions, some of the uncertainties about how this will all resolve, but then also quite a bit of optimism relative to economic performance that has continued to be fairly strong.
That was the IMF's Director of Monetary and Capital Markets, Tobias Adrian, discussing the market's resilience on Bloomberg surveillance this morning. Meanwhile, I do want to bring you some comments coming from President Trump right now. Speaking at the White House, Matt, this is interesting. President Trump saying that we're in a trade war with China now, implying that maybe we weren't before, but right now we are in a trade war. Also making the point, this coming from the president, in his view, that tariffs are a very important tool for defense. Of course, we would expect him to use that argument, as that's one of the bases for why he's been able to implement these levels.
Yeah, for sure. That's one of the sort of IEEPA arguments, and it makes sense. I wonder how the markets will take that statement, I mean, we're in a trade war with China, something that you and I and everybody else knows. But to hear someone, to hear the president say that, it's not necessarily a warm and fuzzy, I respect President Xi, he's so smart and such a great leader kind of statement.
Yeah, of course, all eyes on whether or not these two leaders actually will meet in just a week and a half's time or so. We'll continue to monitor that and, of course, bring you any headlines as they cross. But joining us now on the heels of the IMF and World Bank's annual meetings in Washington, D.C., I'm pleased to say, is Christian Keller, head of economics research over at Barclays. Great to have you with us, Christian. So, of course, you're in D.C. You think about the IMF, the World Bank's meetings going on. I have to imagine the elephant in the room, though, is what is going on when it comes to the trading relationship between the U.S. and China, the world's two biggest economies.
It is an elephant in the room, but I would say in general, if you compare the meetings, for example, to April, I think the economists, and including the IMF, everyone has become a bit more humble. In April, there was a general agreement among the community coming together, particularly among the economists, that the trade policy that the U.S. government was running would be very detrimental, that the uncertainty associated with them would be devastating for the global economy, dollar debasement, etc. And frankly, now we are here 6 months later, and not a lot of this has materialized. Obviously, we have some diversification of trade, diversion of trade, but overall, the economy, in particular the U.S. economy, has been holding up together quite well. And so I don't think that China-U.S. trade spat right now is getting the same kind of attention it would have gotten 6 months ago or so, because there's also the expectation that somehow they work it out. I dare not to say the word taco, but the idea that ultimately, there's an escalation of words, but then they come together. I think that is still quite dominant.
Right. Christian, it's interesting. I mean, you talk about the resilience and, to your point, you think about just the U.S. economy, some of the economic data that we've been getting. Okay, inflation is above the Fed's target, but it's not moving higher in the way that maybe some had predicted when you think about the U.S. posture, not just versus China, but the rest of the world when it comes to these tariff levels. But even still, even with that in mind, when might we actually start to see some of the impacts of these trade wars, as President Trump is calling them, in the official data, which, by the way, we're not getting right now in the U.S.?
That's a good point. Yes. Well, I think, and I should say this to what I said earlier, the belief is still that ultimately what is happening right now, the kind of, you want to call it the fragmentation of global supply chains, the trade wars, that ultimately should lead, to less efficiencies, to increased costs. And, if you look into the details, we do see it in U.S. inflation. We do see it in core PCE, core goods, I should say. Prices are going up. It's just being offset by other elements. In particular, if you look at if they look at rental inflation, etc., where we have an easing, and we expect this actually to continue to go up in the coming month. But as I said, there are several effects at play, but we do see it at the moment already. And I would make another point. It's not only about China and the U.S. I speak to a lot of emerging market, ministers here, and they're really concerned also about the exports from China into their countries, because as they can no longer go into the U.S., they're not, China is still exporting, but they're exporting into Asia. They're diverting their trade into other emerging market countries, and they feel all this cheap Chinese goods coming in, and they say that's not sustainable.
I wonder, Christian, if there's any solution for rare earth magnets, these magnets that we need to make our cars and so many consumer goods and that our military defense industry needs. Is the only solution still figuring out a way to get them from China? I've heard something like 90% of refined rare earths come from China.
Yes, I mean, we at Barclays, we looked at this in particular through a paper a few weeks ago, going through all the details. And frankly, there is no alternative, at least in the short run. It takes a long time to build alternatives. China very strategically, with the world not really watching, I guess, built up or built their position in this market. And you cannot challenge it overnight. I think what the U.S. is now doing is obviously stockpiling. That's one way to do it, right? If you buy a lot and create a stockpile, that is costly. But in the short run, that's probably the only way to make yourself more resilient. And that also does give China still a very strong card in that game, if you want to, the game they're playing with the U.S. in this trade conflict.
I mean, is it the strongest? J.D. Vance was on Fox last weekend saying, the president of the United States has the cards. Do we have any card like that?
Look, the U.S. has the card that it's still a very large market for China. I said it earlier, China is trying to now substitute the U.S. with other markets, trying to export into Europe and other emerging markets. But, that cannot really make up the loss they have from, no longer getting easy access to the U.S. That is a strong card. I think still in the high-end chips, that is a strong card. I think that unnerved China, that the U.S. has tightened controls on these, cutting-edge chips into China. But the U.S., of course, doesn't have that one single card of the rare earth, which is very particular to China. And China also, of course, has the card of, hindering U.S. cooperation in the U.S. in China that we see already, through all kinds of investigations outside of trade. And it is maybe a situation whereby China has a better position, I think, than the U.S. administration thought when they started this, than in terms of in this bargaining process. I guess in game theory you would call it, they have escalation dominance. And I think that's something that we will see play out now in the coming weeks.
All right, Christian, great to get some time with you. That is Christian Keller. He is head of economics research over at Barclays. And speaking about the economy, today our very own Romain Bostic was at the CAIS Alternative Investment Summit for a conversation on investing in tomorrow's economy. Here's part of that conversation.
You need power to run these data centers, but you also need power because we're electrifying everything. And the biggest driver of electricity demand is that we're moving from carbon-based cars to electric cars. Mm-hmm. And for the first time in 20 years, we're actually going to be needing more electricity. Last 20 years, electricity production in America has been constant. We need about 40% more than we currently generate over the next decade. And so there's a huge investment that you need to make in generation and transmission and storage. And that number, just to give you another T number, McKinsey estimates between now and 2040, we need 23 trillion. That's like almost our whole GDP in power, infrastructure, and generation assets.
So Ken, though, I mean, where's that money going to come from? I mean, I know now some of that money is coming off of balance sheets, but at some point, some of these companies are going to have to go to financial markets to get it.
Absolutely, and I would say that I think that's obviously a lot about a lot of what we're talking about here today and yesterday. And the reality is that the private markets, the alternative investment world, is going to power that. So there's a link between the democratization of alternatives and private capital and funding that infrastructure build out and that growth. I mean, if you look at overall, where that capital will come from and has moved from, it's, capital can move more quickly in the private markets to opportunities. It is funding in large part what's happening and significantly not from the banks. I mean, if you look at where most of the capital is coming from, it's coming from private credit managers. It's coming from private equity investors. We're an investor today in 350 U.S. private equity funds, obviously tracking where they're investing on a regular basis. Directly, we have investments in about 50 companies. And although we're not, like my colleague here, we're not a direct investor in data centers. We're an investor in, and I think this is sometimes overlooked, all the infrastructure and all the businesses that are feeding into those data centers, right? So today we have investments in 50 companies in engineering, in software development that are all playing into that. Over $6 billion invested in the mid-market companies that are feeding into that transformation. So I think that private markets, private credit, private equity, alternatives overall, and certainly what's happening in the democratization of alternatives is playing directly into investment in that reindustrialization.
Milton?
So, there's no one single source. When you listen to the numbers that McKinsey and others expect in terms of the demand, right? You need the banks, you need insurance companies, you need the wealth industry, and what you need is long-term patient capital, right? And so far, we were having this discussion a little bit last week. So far, it's been fairly easy because most of these particularly large data centers are being built for the Amazons of the world, the Googles of the world, And so you can leverage their credits, right? But at some point, their balance sheets are going to get stretched too, because capital is not infinite. And so at that point, you're going to have multiple sources. And frankly, the businesses sitting in this room today are going to be a big participant through the assets, long-term assets that they're managing in the industry. I think returns are likely to be softened, right? Today, everybody's excited because the returns look more like private equity than they look like infrastructure returns. But once we get to a more normalized environment where you're actually looking at the underlying credit, I think returns are going to come down and look more like your traditional infrastructure play.
But when you look at infrastructure, really real estate overall, Milton, there's been this idea that the old sort of static nature of investment in real estate, that's over, that what investors are looking for now has to be much more evolutionary and much more dynamic. What are you saying?
Look, I would agree. You know, real estate today is being built for purpose as opposed to for location, which historically they've done. And so I think today everybody understands where the puck's going. They know where the demand is. And so therefore, if you're going to build, you're going to build where you know there is demand, and there's unlimited demand and unlikely to change given the data, the amount of data being generated and the need for power and the need for infrastructure.
Mm-hmm. And regionally, AJ, where are you seeing? I mean, I know that in the past, Blackstone Real Estate has been heavily invested in the Sun Belt states. Is that still the area of growth?
Well, we're tending to invest by asset class where we see the best demand-supply balance. And if we think about, for example, these pillars of the reconstruction or investment in America, and when we look at data centers, you not only need to have land, but you need to have power from utilities or a direct connect to like a natural gas source of electricity. And so where we're finding power today is in Texas and Arizona, Pennsylvania, which has 20% of all of America's natural gas, Iowa, Georgia, which, by the way, is a state that commissioned the 2 most recent nuclear reactors in America. And so when you think about the data center business, you have to also think about where you have excess power to basically fuel these data centers.
And that was Bloomberg's Romain Bostic from the CAIS Summit. Sources say he'll be back tomorrow, but you'll just have to tune in. Let's take a look at some of the movers in after-hours trading. You can see United Airlines now turning lower, which is interesting. We know that they beat when it comes to the third quarter. They really lifted their expectations for the fourth quarter, but traders seeing something that they don't like in those earnings. A different story for JP Hunt. The transportation and logistics company reported third quarter earnings that beat expectations. You can see shares flying up almost 12%. This is the close on Bloomberg. U.S. ETF inflows pushing back past the $1 trillion mark. That is the fastest asset haul the industry has ever seen. Joining us now is James Seyffart of Bloomberg Intelligence. He covers ETFs. And James, it is pretty amazing when you think about the pace of inflows here. Where is the money going? What's hot right now?
I mean, everything. I mean, equities are up. I mean, treasury bonds are taking in tons of money. I don't need to talk to you about how well gold is doing and gold ETFs, and then you get to crypto and Bitcoin ETFs. I mean, the real question is like what's not doing well, and I haven't paid that close attention to it, but it seems like everything's doing well and everything is taking in money. We have these 3x leverage ETFs. We have single stock ETFs, these buffer defined outcome or boomer candy type ETFs. Everything is taking in money hand over fist.
Boomer candy. I love it. I identify as a boomer. James, one thing that I think for you and Katie, this is obvious because you live in this world, but markets don't have to be going up for ETFs to go up in terms of flows, right? I mean, people will buy ETFs to short stuff as well as to go long stuff. And there are more ETFs than there are stocks, as we say all the time. So is this growth dependent on continued new records?
Not necessarily. I mean, there is a correlation. When the markets are doing well, particularly the equity markets, you tend to see, higher inflow years. But that doesn't mean that you don't see massive inflows still to the ETFs. There's this underlying trend that tends to happen. Money's coming out of mutual funds in different areas, and people are using ETFs for more and more different things. So yes, it helps when the market's going up, but it's not a requirement. I would say it likely is a requirement. You probably need somewhat of an up market for you to see these types of new records that we're going to see this year, almost certainly, with the fact that now we've taken in $1 trillion so far this year. But we're also seeing record launches. I mean, we're going to see a record number of ETF launches this year.
Well, to that point, James, I think it's interesting that you mentioned that everything is hot right now. That is certainly true. But you think about bond ETFs. Athanasio Sarafagis had the good chart that you take a look at bond ETF launches as a percent of overall launches, and it's at the lowest level in about 10 years. So it seems like maybe there's been a little bit of a cooling of appetite when it comes to fixed income ETFs.
Yeah, people aren't launching them as much. I think a lot of people tried to do like some more slicing and dicing of the fixed income ETF market, and investors just don't care. I don't know if it's because, you know, there's not as much vol and return in that space, but you have, like I said, you have single stock ETFs, but you can't even get people to buy, you know, single sector fixed income products. So I think a lot of it has to do with the kind of market we're in. People are very interested in some very spicy leverage types of things that we've seen, cryptocurrency ETFs. There's a part of the reason that fixed income is down because we're seeing so many of these other derivatives-based, leveraged, hot sauce type ETFs come to market. And that's part of the reason why the actual launch numbers for fixed income products is lower.
The more hot sauce, the better. James Seyffart of Bloomberg Intelligence, thanks very much. And I would be remiss if I didn't plug Katie's newsletter.
Thank you.
ETF IQ.
It comes out Fridays at about 2 p.m. if I file it on time. So please subscribe. Bloomberg.com/ETFIQ newsletter.
Still ahead, what investors need to watch for the next 24 hours, including Jefferies Investor Day following the fallout from First Brands. This is Bloomberg.
Well, all eyes are on Jefferies as the company prepares to hold its Investor Day tomorrow. Amid the First Brands fallout, Bloomberg Intelligence estimate that the loss that Jefferies suffered from their exposure to First Brands could be as much as $45 million. Neil Sipes, he is financials analyst for Bloomberg Intelligence. He joins us now to discuss. So we were talking about timelines in the commercial break. So this was previously scheduled, this Investor Day, but it certainly got a lot more interesting just in the past week or so.
Yeah, and so this is a regularly scheduled Investor Day. We know Jefferies has a bit of an odd fiscal year. They end a quarter early. They tend to be that first look for the big U.S. investment banks. They don't host earnings calls, so they tend to give you a little bit more detail every year at the Investor Day, how the business is doing. Of course, as you noted, things are going to be a little bit more focused maybe on that asset management unit, given the Point Bonita exposure with First Brands. Again, that $45 million number that you quoted, we calculated that. They have since sort of confirmed that type of range as an estimated loss. That's about 0.5% of tangible equity on the balance sheet, about 3 to 4% of annual profit. So it looks like the financial hit is manageable and something they can absorb. The bigger question
That's
now,
like a top trader's salary, right?
Yeah, and the
That's
bigger
what Ryan Gosling gets on a check in The Big Short.
Something like that, right?
Yeah.
I'll have to confirm that with him, but I think that's where some of the focus is going to be tomorrow. Is, you know, how do we mitigate the longer term fallout, which is the reputational risk within the asset management unit, any sort of bleed out into that core investment bank. That's going to be some of the focus. Otherwise, investment banking, as we saw with results from Jefferies a month ago and from the bigger banks in the past couple of days, is on fire, right? M&A's back, IPOs are picking back up, trading has been strong for quite some time now in this market. So,
and they have a fantastic reputation, right? Stellar. Katie, you were just talking about the
Archegos, Rich Handler, have it down by the time my margarita arrives. Do they still have that good reputation?
Yeah, I think they do, and I think, again, this is sort of the investment in First Brands is one of the affiliate funds through Leucadia Asset Management, which is Jefferies' fund. Jefferies did have a 6% equity stake in Point Bonita, so they're going to share 6% of those potential losses related to First Brands. Obviously, there's been rumors of fraud within that, so it's going to be a question of what do the recoveries look like. and ultimately what is the longer-term fallout. But again, this is sort of a fund that Jefferies was offering and co-investing alongside with clients, not necessarily a huge balance sheet hit from the math we've done.
All right, well, looking forward to maybe getting some more details tomorrow at that Investor Day. That is Neil Sipes, financials analyst for Bloomberg Intelligence. Meanwhile, Matt Miller, it's been so much fun.
It's been fantastic.
Yeah.
Thank you so much for having me. I really appreciate it. Romaine Bostick will be back tomorrow. Balance of Power is up next.
This is Bloomberg.